Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner of Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Welcome, Ian.
Hi, Don. How are you?
We're also joined here today with a guest and subscriber, Dan O'Brien. Dan, give us some of your background for the viewers who are listening in.
Yeah, thanks, Don. So my name's Dan O'Brien. I'm currently an FP&A manager and working for one of the top automotive financiers in the country in Australia here. And yeah, we obviously do a lot of forecasting and budgeting, so all things macro are very interesting, something that we keep an eye on, working closely with our treasury team. Also, been following Bitcoin since about 2017, so always interesting to have Ian's views on how the crypto market's going to go moving forward. Probably back to yourselves now, just to go through our press release.
No, thanks, Dan, and great to hear your background and definite interest in the topics and subjects that we provide. So look forward to some questions from yourself later as we go through. So making money in stressed capital markets is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address US $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Luckily, Ian is here with Siberia's capital latest press release. Ian, tell us more about markets are cracking.
Yeah, so we've seen markets relatively stable, believe it or not, in the time of the Iran war, which is longer than we think now. Yep. And markets are now, as we said last week, getting bored with it. So we've moved on. We're moving on to what's happening in the economy and what's happening in macroeconomics. And the first thing to happen was that dollar yen went above 160. We'll talk about that in the charts later. And the Bank of Japan had to intervene, forcing it down to 155, so 160 to 155, and torching $35 billion in reserves, apparently. Right. They've done this a number of times, and I'll show you when we get to the charts why they're doing it at this level. But we've spent, when is it? Let's have a look. We spent, 4 or 5 weeks in the Iran war with it not daring to do anything. But now that central banks have done nothing, markets have got to get on with pushing them into a reaction.
Right. So the banks themselves, as I said, taking some action simply because they couldn't do anything for a while. But obviously, given what's occurring in relation to the oil crisis, the impact that it has.
Well, the Bank of Japan sold $35 billion worth of dollar yen to push the yen higher, dollar lower. It's bounced back a bit, but you don't get your money back from $35 billion because it's gone forever. And you can, you've got to borrow those dollars if you need them. You can print your own yen, but you can't borrow those dollars unless you get some from the Fed. So it's kind of like intervention is always okay, but you got to be really careful. A la Bank of England 1993 when it got chucked out of the ERM.
So, and are they the only central bank that are needing to do this?
Well, they're the only central bank that has done it so far. Otherwise, I don't think that currencies really are such a big thing. Japan is the one that has got all the focus because of 250% debt to GDP, etc., printing money like crazy. Bank of Japan owns more than 60% of all of the outstanding debt of the government, so they've got nowhere to go. Market's been hammering them, push rates up from 0% to 3% in the 30-year this year. So they're the ones under pressure, and they're the first to crack, it would seem.
And so the other countries you feel are in a better position and therefore not needing to do action at the moment?
Well, not currency action anyway. So this week was central bank week. So we had the Bank of Japan first, who declined to raise rates, but were split, 3 dissenters, which is unusual. Yep. Followed by the Fed, who didn't raise rates, and that was split, 4 dissenters. Very, very unusual. Last time, 1992. And then followed by Bank of England, Bank of Canada, and ECB, who didn't do anything either.
Yep.
But the point of the press release this week is, we've got energy shock, 2 concurrent important wars. We've got lots of bad economic things happening in the States. So we've got a credit crunch in private credit. We've got small company bankruptcies, the worst in history, and all that sort of stuff, commercial real estate, etc. So we've got this enormous backdrop, but yet no one wants to do anything. Yeah. So the point is, the thing that distorts markets, which causes crashes, is normally central banks refusing to do anything. So you could say interest rates super low after COVID. It took way too long for central banks to raise rates. Therefore, we had 9% inflation in the United States.
Right. Okay. Very interesting. Do you want to move through the charts now?
Sure. Okay. So here are the charts, Don. We normally go left to right, starting with Bitcoin, which is normally the most popular one. And so we've seen with Bitcoin a big fall from the top, even though equity markets haven't done so much and are now at their highs again. And so the buy zone, which has been defined from this previous area, has actually succeeded in propping price up. Yep. And we're now seeing what could be a similar bear flag here before another fall, or not. What we do have is the 200-day moving average really putting a cap on it. And although it's not so exact in Bitcoin, it's much better in sort of bonds and stuff like that. You can see that it does definitely adhere to it, although it breaks. But if Bitcoin's going to go up, it's got to break that 83.5 level. And then we've got to see it pushing back, most importantly above this, 97 level. And above that, then, we can go back to the all-time highs.
So are there certain things that's going to trigger that either way?
Well, a big fall in US equities could push it a lot lower. Continued rise in US equities from the current all-time highs would push it higher. The war in Iran being over, the war in Russia, Ukraine being over, plenty of good things that can happen, because let's face it, we're full of bad things at the moment. But really the underlying thing with Bitcoin, as I think Dan wants to talk about later, is that there's lots of things internally to Bitcoin which are stopping it going up. For example, technology that is going to break its encryption. Not that it's encryption, it's cryptography, but plenty of structural things that need to be addressed before investors can really get in wholesale, I think.
Yep.
Although it's not doing badly, I must say. Better than Ethereum, which is kind of like hard work. It's a messy chart. I've been buying it on the basis of sooner or later we're going to have to actually go through this tokenization of real world assets, but it's hard work. It's grinding up. Gold. Gold is really steady, I would say. We need to put in a new high above 4,900 to really get it going again. But it's really a consolidation from this big breakdown, and it's going to need months and months for this to really build a base again. And when we look at gold and that 200-day moving average, you can see on a real bull market, that 200-day moving average really does keep the trend intact. And it's only when you get so far away from it, for example here, where the moving average was, 3,700, 2,800, and the price was 5,600, that the market's got so far ahead of itself it has to come down.
Yeah.
And that happens almost every time in risk assets, and you can see it particularly here in silver. And let's actually hide those, because you can see that massive blow off top. And to recover here, we probably need to hit $62 again, or however that grows over the months. But it's going to be pretty hard work, I think. I'm kind of sounding like last week's charts, but oil, we see spot Brent. Well, it's your guess as good as mine what's going to happen here, and purely dependent on events outside our control. I would suggest it's going to push the upside. Plenty of people talking about $200 oil, which I don't disagree with. But nothing really to see there until something else happens. Here's dollar yen, which we were talking about before. So you can see that we've had all this mess here. And here's the big down day as we pushed above 160. And I'll show you another chart of that in a second on a different platform. The dollar and the Dixie futures, mainly against the euro, we've got this big channel uptrend that's been there for 10 years, which is the lighter bit, sorry. And we've broken down and we've broken back up, and we're just sitting there waiting for something big to happen, I would say. In bonds, everything's been tracking the 10-year US. So we've had a big spike up, and now it's going back up again. 30 years probably more interesting, in that you can see that we're forming a big wedge, so that zooming out we can see there's a big event about to happen as this wedge gets confined, and we'll look at that in dollar yen in a minute. So we've looked at these things many times, Don, and it's going to go berserk one way or the other. Curiously, I seem to have the ASX here, which I almost never look at. And I think the ASX is pretty confused. It looks okay, but it's really just driven by what's happening in, for example, the S&P 500, where we've had a big rally, an amazing rally, on the back of, I think, the need for much lower interest rates and the willingness of a new Fed chair backed by Trump, etc., to get those. And we've had a breakout, but we've got a reversal signal here, in that although we closed higher, it closed at the low of the day. So that's a very solid signal that markets are going to go lower. And the NASDAQ is pretty much the same. So can the market continue to push higher? Lots of people saying it can't, lots of people looking for a crash, but it still is up there.
Yeah.
I'll just stop sharing and go into another window just to show you. Tell me if you can see dollar yen.
Yes, I can.
Yep. So this is dollar yen monthly. So this goes back to, where does it go back to? 1972. So you probably can't see the left-hand side of the screen, but it comes from up here, which is 365 yen to the dollar. And we go down to 284, up to 302, down to 180, up to here to 276. Then we get some more meaningful data. But as Japan came out of, this is really zooming out, as Japan came out of World War II, it was an economy subservient to the United States and a very weak currency. It became the global manufacturing center. And obviously its currency was so weak, it was ridiculous. So when, the likes of the big Japanese electronic manufacturing companies started ruling the world. At 1985, which is here, that was a Plaza Accord where all the central banks agreed to sell dollars for yen to push the yen up in value so that Japan wasn't so competitive. And eventually, very soon, led to what we saw here in Australia, which was it popped that housing bubble, and all the Japanese that came to buy stuff on the Gold Coast got absolutely hammered.
Yep.
And as you can see, it hasn't really recovered ever since. But this is the level we're at now, 160. So it's trying to defend this level because we could see a rapid decline up to 260 or something, crazily enough, if markets get fully in charge of this and take the Bank of Japan out. That's the big worry for the Bank of Japan, because then rates would have to rise significantly. And when you think of the appreciation of the yen from 160 down to, what was the low there, 75, you've got to say that's like the Aussie suddenly becoming $2.50 or $3. It's a huge change for your entire economy, and you can't let those things happen too quickly.
No, absolutely not.
I'll stop sharing on that basis.
Thank you. Thanks for that, Ian. Very insightful again. And you made the comment about we would seem to be talking about the same things last week, but as you pointed out in your release, if we don't have action, markets will crack as a result. So I think that probably reflects part of that as well. So thanks for that. We come to the part on the podcast where it will introduce Dan O'Brien. Dan, thank you for listening in and joining us. We'll be interested to take a couple of questions from yourself, either in relation to the presentation today or other pre-prepared questions you may have. Over to you, Dan.
Yeah, thanks, Don. Appreciate that. Can you hear me all right, mate?
Yes, we can. Thank you.
Yeah. So I think I might hone in on the global reserve currency comment that you made, Ian, and where you potentially see Bitcoin in that. Obviously, there's a couple of things hanging over it, as you said. Obviously around the Clarity Act and the need to make Bitcoin quantum resistant. So I know that both of those are in the works at the moment. Bitcoin Core obviously have a big task on their hands there, but have said it can be done. The question is, can it be done in time? And I think the one thing to call out there is, Bitcoin's one of the things that I've heard is that Bitcoin's effectively using the same cryptography as what's protecting the nuclear warheads. So in a way, if quantum computers can crack Bitcoin, they can crack the cryptography behind that's holding everything safe. But, so it's an interesting one. But really, what it means is can Bitcoin be secure in time? And like you said, then if that's something that can be done, we could see BTC potentially come out a lot stronger over the next decade.
Yep, maybe.
Thoughts on that?
So, bearing in mind, I worked for massive banks in my time. So, I used to turn over, I don't know, $10 billion every day without problem, right? So, when you think of $1 trillion market cap, it's tiny. The capital required to get it to gold, let's say, as a typically popular comparison, is enormous, right? You have to have a massive systemic change that pushes the banking system into a private money, which, when you look at it, sounds incredibly unlikely. But it could happen, right? So no one thought 5 years ago people would seriously be thinking about going on the gold standard again. But to a lot of people, that seems a better choice now. So the gold standard was never able or built, because of course it's 5,000 years old or whatever, to deal with countries that print their own money. So is it the best choice? Well, it's the obvious choice, because no one's going to go straight to Bitcoin, in my humble opinion. Does being quantum resistant make any difference? I don't think so, because nothing is quantum resistant. In fact, we haven't even really had any quantum computing that really has done anything or allowed to do anything. Will it be allowed to do anything? Will AI be contained? I think there's lots of regulation that's going to come in that's going to stop all of this stuff before everything unravels, not just talking about Bitcoin. And as usual, Bitcoin, because it has no CEO and no representatives and no voice, apart from a few of us, of course, it always is the one that gets hit first, isn't it?
Yeah, and I tend to agree. I think there's a place for BTC in the global asset market now, and as you said, it's very small in comparison to all of the other asset classes. What we're talking like a trillion, a bit over a trillion compared to what equities are over a couple of hundred trillion. Global real estate, hundreds and hundreds of trillions, and I think that the derivatives market 2 quadrillion. So, the interesting point you made before was probably around tokenization of real world assets. That's where things could heat up, I think, over the next decade, purely because it takes friction out of the process, and obviously you can divide the assets up, pretty much to infinity. It's an interesting one there, and you made a comment on that before with Ethereum.
Yep. Everyone's talking about it. Some people are doing things about it. It's a complete no-brainer. No one's arguing about it. As if you want to bring stable coins to be a savior for the United States, then you might as well bring in tokenization of real world assets, because it really, really enhances it. So you can see that if a solution is the United States controlling the global economy using stable coins and swap lines, then you'll want to have all of those transactions in a digital native currency, I would have thought, and secured with much better method of securing it and cutting out all those middlemen, all the stuff that everyone can fill in the gaps there. So it's obvious, but when's it going to happen? I don't think that the time is right now, but as we decide what happens with Fort Knox, maybe, and we decide, is gold something we can use? I actually think that's probably going to be more for Russia or China or whatever in their currencies. As we try and look at $39 trillion in US debt, we can't possibly manage that using traditional financial methods, because it's not scalable enough. And every single time a country has got themselves into this sort of condition, and it's the worst condition ever in human history, they've always failed. So there can be no confidence in trying to get themselves out of it the way we're going. So we have to move on to something else. The big question is the euro dollar market going to come in to play in this? Because there's something like, no one knows, but there's something like $80 trillion, I believe, in outstanding liabilities in the euro dollar market. Every week I used to produce Eurodollars in London out of nothing, because that's a fractional reserve system, and no one recorded it anywhere. So if that's numbers right, and that's a BIS estimate, I think it is, that's 4 times the money supply of the United States. So when you have a global reserve currency, not really many people understand where all those dollars actually are and how to manage it. So if the United States is going to keep the global reserve currency and is going to do something about that debt, then it's going to have to do it taking the Eurodollar market into account. So it's going to have to use stable coins and swap lines in a coherent strategy with some sort of blockchain solution for real world assets to move everything instantly to a new, let's call it a paradigm for the sake of argument. I don't have to be too precise, but it's got to be that huge move at the right time to make the difference.
So we've seen a lot of central banks stockpiling gold and countries stockpiling gold as well.
Yep.
Do you think that continues? Like if you're Just on this point around gold potentially becoming the global reserve currency and possibly a tokenized stable coin backed by gold could be an option. Do you think that that stockpiling of gold probably continues over the next few years?
I think there's a plan, like there has been a plan with tax for the G7 for the last 20 years. If you read all the minutes, it's all about tax. There's a plan somewhere that we're going to do whatever it's going to be, and fiat currencies are over, because every fiat currency that's ever existed has gone to zero. So even central bankers must realise that. So why wouldn't you have gold, especially as your competition is loading up on gold? It's kind of a race. The more China buys, the more Turkey buys, the more everybody else buys.
Wonderful. Daniel, thank you for those questions, and I'm sure we'd love to keep talking because Ian, you're a wealth of knowledge and we really appreciate your input. Just wanted to move on. What's coming up in the next week, Ian?
In terms of economic numbers, etc., RBA tomorrow, Reserve Bank of Australia. What do you think is going to happen, Don? I always ask you this.
Oh, thank you. Well, don't think they're going down. So are we up or are we staying the same?
Don't know. What do you think, Dan?
Yeah, I think last I heard we're sitting around 60% chance of a hike, 60 to 70% chance of a hike. I think if I had to bet, they'll hike. They'll go 25 bips. If I had to call it.
Yeah, I reckon that's right too. They've got to erase those cuts because that was a policy error. 2 policy errors now in the last 5 years. There can be no confidence left soon. Otherwise, pretty quiet until we get to the end of the week. So we've got non-farm payroll, which always used to be the big banger in the markets, because the BIS, not the BIS, that's Bank for International Settlements, the BLS, Bureau of Labour Statistics, has been actually lying about the numbers for the past 5 years. Markets don't really believe it so much. It becomes more of a trend following thing rather than an actual number shot.
Exactly.
So those are the things next week, but some interesting things today. US to guide stranded ships out of the Strait of Hormuz, says Trump.
Yep.
I can just see Iran releasing their own counter thing saying Iran to guide stranded US ships out of the Strait of Hormuz. Banks seek to offload risks to avoid choking on data center debt. This is a really, really big thing because banks have been using new off-balance sheet methodology to remove risk because they'll limit up on their loans to data centers.
Yes.
Berkshire cash pile climbs to 380 billion as stock sales streak into 14th quarter. So, the world's best investor is still sitting on more and more cash, even though he's not actually running it anymore. I'm sure he's the one that's guiding it behind the scenes. So,
and he's saying only quality, and I can't find quality, and I'm not paying dividends. So I'm sitting on cash.
Because he just looked that up. Well done. No, exactly right. And everyone that can look at these stock markets go, you can't buy this because you're not going to make any money in the next 10 years. Okay, that Joe Public, who's got some money on his Revolut app or whatever, doesn't know that. So there's thin markets driving the market up. So I think we really need to resolve where the US equity markets are going, and get some direction from that.
Excellent. Thank you. Well, that's another wrap of this week's Limit Up podcast. So I thank Dan and Ian's attendance today. So thank you again. This and previous podcasts can be located on the Siberia Capital website. Alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Thank you.
Thanks, guys.
Thanks, guys. Cheers.
Thank you.